Good morning, students. We will start today's session. And basically, before we have been discussing, the topic of mergers and acquisition. And mergers and acquisition, frequent question in the exam. So basically, mergers and acquisition, there are two different definitions. Mergers is basically you get together and create a new company. Now, when you come into acquisition, basically acquisition means two. There are two companies. One is going to be acquire existing company, so that both the companies will exist. Both the companies will exist. But when you come into merger, existing companies will not be existing, will be there. So the new company A and B create a new company called C, that is merger. A acquires B means A will exist, B will continue with their operation. So that if the A acquires B, A becomes parent, B becomes subsidiary or associate or whatever. So that is a consolidation relationship. That is, we come to group accounts. So when you come to group accounts, then you have parent subsidiary relationship. So that's what we have been doing. And then we have discussed some technical side, associate. How do you design associate? What's percentage you want to become an associate? And when you associate, what is the impact? How do you say that this is an associate rather than having a shareholding percentage? And how do you decide a subsidiary? How much do you want to acquire of acquiree? And what are the other alternative criteria you to be satisfied to become a subsidiary? Is it only the shareholding or something else? So different criteria we have learned, and also we have learned some. I will giving a note. I will upload some notes today, later today, and the payment mechanism also. We have discussed the historical value, that is net present value, and replacement fund and free cash flow. Those are the three methods available. Replacement fund. Those are the methods available for you to decide the purchase consideration. Purchase consideration is the amount you want to pay to acquire, right? So basically, when you want to acquire a company, we discussed the audit you need to complete. We call it due diligence. Right? So the due diligence is a diagnosis test. Due diligence is a diagnosis test. So you do to see whether this company is going to be okay or the comply with the parent companies or the acquirer's standards. So we don't know what are the hidden things or the qualitative things which are not reflected in financial statement. So everything you will get to know by doing a due diligence. So basically, due diligence is going to be performed by an auditor generally. So it basically covers everything about company. legal affairs, financial, not financial, labor matters, everything. That's going to be there when you're doing a due diligence mechanism, due diligence test. So, and also we have learned some integration method. Remember the horizontal and vertical. Horizontal means basically you acquire same line of business. Vertical means different line of business. And you have then you have inward, so the forward and backward integration. So everything we have discussed, and keep in mind all those things. Important for you to understand that when you sit in for the exam. And also I thought of the next we'll have to discuss with the capital restructuring. And I have given some notes on and given some notes on this one. How do you prevent a takeover or acquisition? Once you've been acquired, how do you act post of a defense mechanism? This is after you being acquired. This is before you being acquired. So there are defensive mechanisms available. There are defensive mechanisms available. So banks or the companies are actually implementing these kind of defensive mechanisms to avoid acquisition. And somehow if they acquire direct or indirect method, they'll have to apply these things. And we also discussed the direct holding and indirect holding. So basically you can directly go and purchase a company, or you can indirectly go and purchase a company through indirect indirect acquisition comes how? Through your existing subsidiary. මට දැන්ට කම්පැනියක් තියෙනවා නම් අයිති වෙලා මම ඒ කම්පැනියට කියනවා මම ගන්නෙ නෑ කියලා shares මට ගන්න ඕන කම්පැනි. For example, now if I want to acquire John Keys, මට තව කම්පැනියක් තියෙනවා XYZ කියලා. නම් මම John Keys කියලා ගන්න යනවා. ඒතර මම ගිහිල්ලා direct ගන්න පුළුවන් John Keys shares. Oh, I can ask my XYZ company which is owned by me, controlled by me, the subsidiary of mine, to acquire or to invest shares in JKH as well. So that I have direct holding plus through my subsidiary I have indirect holding as well. So once you take together direct and indirect, you are completing 51%, meaning you become or the Georges become a subsidiary of. That's all. It doesn't matter whether it's direct or indirect, but as long as you are maintaining the shareholding percentage through direct or through indirect, so you will be or you will become a parent company. So you are acquired, you become a parent company. So that is important for you to understand these things, right? And I just want to discuss with you because I thought of discussing with you this topic as well, the latest economic situation of the country, which is sometimes going to be worthwhile for you before you sit for the exam. And recent exam paper also examiner has tested few number of questions on share market, few number of questions on share market. So then I thought of giving some idea, and examiner can test you based on today's scenario. how do we, what are the things, what's happening in Sri Lanka now? You know, we have passed, we have actually gone through the pandemic situation. We have gone through difficult situation in 2020. So then how the economy has rephrased is very important, and what are the things we can do and what will happen in the future. The economic fundamentals we have already learned. We have learned on interest interest scenario, and examiner can test you. Given an example, it has been tested over the years, right? When the interest rate coming down scenario, what will you give an example? Given a text type question, interest rate is coming down, and he is giving some economic fundamentals to you. Inflation today, next year, after 5 years, then the GDP growth, then the 10-year bond prices, then 10-year bond rate, inflation, all these fundamental economic fundamentals we have learned in the class depending on the present situation. So the example this time also, the latest paper also, he has given some economic fundamentals, and based on that he has asked some questions on that. So basically then if you know, so those questions are very much like whatever the economic fundamentals we learn, so the examiner test you the economic situation prevailing at the time you are sitting for the exam. So for example, we say now today we are actually experiencing a low regime of interest rate. Now say when you sit for the exam, June or whatever, when the interest rates started to go up in Sri Lanka, he will not test you low regime of interest rate. He will instead of low regime, he will test you upward trend of interest rate. So the question will be based on that only. The answer you provide during the time of lower regime of interest rate completely different from the increasing trend of interest. So that is important for you to understand. For you to understand, for you to have the knowledge updated all the time. Right. So I'll give you one example. The recent one. Now, now this is the 1 week before. This is not downloaded to you, right? This is the latest 1 week before, not the last week, the previous week. 1 week before, 3rd March. No, this is the latest one. No? Okay. This one. This is the 1 week before, not the previous 1 week before. The treasury bill auction. We have learned this, right? Now we have learned, if you go to your notes, previous notes, early notes, so we have discussed treasury bill rates coming down. Remember? When we started the session, I told you, I have given you some advertisement and the results sheet. There you have seen treasury bill interest rate compared to the previous week. It has lowered, it has come down. But see this one. Now today, this is February 21st, 23rd of February 2021. Compared to the previous last auction and see the current auction results. It was previously 4.82. Now 23rd of February it has gone up to 4.9. 3 months treasury bill rate, which is a risk-free. Treasury bill is a risk-free. 493 has gone up to 4.99. 5.09 same as it is. It has not changed. But shorter term, 3 months, 6 months, government has given a signal. There is a tendency of going up interest rate. And see the latest interest rate treasury bill auction results. This is the latest, previous week. This is the latest results, treasury bill. Now see, what has happened the 1 year? Sorry. 493 months has gone up to 4.95. 6 months, 499 has gone up to 5.03. And the previous week, the 1 year has unchanged, constant, not changed. But this week has gone up by 0.1%. Meaning is what? Meaning is interest rate tendency is to increase. But you can see, you can hear that all the economists or a central bank, everybody says interest rate will come down or prevailing interest rate will be there for sometimes. So there are two fundamentals here. Why the government, why the Sri Lanka needs to bring down or have the low regime of interest rate. So one thing is government is expecting a credit growth, 14% credit growth. Credit growth එකක් interest rate පල්ලෙහා තියෙනවනේ මිනිස්සුන්ට ණය ගන්න. So when you're working in a bank, people are asking lower interest rate. Right? So they don't go and borrow at higher rate. They don't. So then low regime interest rate has to be prevailed for lenders, for the borrowers to borrow. That is one thing. So we are expecting 14% credit growth. Now the present credit growth is 6.9%. Right? So that we have not achieved the target credit growth. So we are expecting interest rate to be remain as it is. So that is one thing. But in the meantime, the amount government is taking from the public, treasury bill is same. Treasury bill is an instrument, rupee denominated instrument. Government is taking money from the public. Rupee funds, short term, money market instrument, risk free. So it gives interest rate increase. So your bank deposit has not been increased yet. Increasing. And the fundamental one thing has given treasury bill rates tendency to go up. And similar to this, treasury bond rates also has gone up. Treasury bond rate also has gone up. That is true. That's true. So we are expecting in near future interest rate to go up. The only thing that there is a contradictory thing. Government is expecting to have credit growth at 14%, then they need to have a lower regime of interest rate, whereas government instrument pays higher interest rate. So generally, if you are given a question in the exam, even these kind of situation, basically you decide whether the country's interest rate is going up or not. Basic economic fundamental is, basic economic factor is policy rates. Policy rate has not been changed. What are the policy rates we learned? SDF and SLF. Earlier we call it repo and reverse repo. Standard deposit facility rate and standard lending facility rate. What do you mean by this? Anything excess in the banking system, central bank, you can deposit, banks, private dealers can deposit excess amount in the central bank. What's the rate central bank pays you? 4.5%. Central bank pays for the banks 4.5% for the excess overnight, 1 day deposit. If the bank needs money, so they will borrow from the central bank at 5.5%. 5%. Those are the two policy rates available in Sweden. Apart from that, we have bank rate, which is 850. Now it has come down from 15%. And also we have SRR, which is 2% now. But generally we say if it is policy rates, we take it SDF and SLF. But SRR bank rate also it's a kind of economic fundamental interest rate, right? So the basic policy rates, if you ask in the exam, policy rates means SDF and SLF. Those things have recently not changed. So if the government or the central bank changes policy rate, two policy rates, then we can understand what will the direction of interest rate in the country. If they increase, we expect the interest rate to go up.
Excuse me, sir.
Yeah.
Sir, it's better if you can increase the volume. We can't hear you properly, sir.
Oh, okay, right. Okay.
Thank you.
So basically, interest rate, we are expecting interest rate to remain as it is. So why we are expecting interest rate to remain as it is? Government is expecting credit growth of 14%. So when you are expecting a 14% credit growth, so you will never increase the interest rate in the country. So basically what I discussed so far, SDF and SLF rates, as it is not changed recently, it has come down drastically over the years. Now recently also there was a monetary policy meeting, and the central bank has not changed that. So still 4.5% and 5.5% is the SDF and SLF rate. So even the treasury bill rates have increased. Now, as you see now, 3 months, 6 months, 1 year. Now 1 year, this is the recent time, first time we have seen 1 year treasury bill rate has increased. That's why I wanted to bring it to you all. So previously it has not been increased 1 year. Now the 1 year treasury bill rate also started to increase. So the giving a signal, there is a tendency of interest rate increase. But in the meantime, government policy rate has not been changed. Policy rate has not been changed. SDF and SLF remain as it is. Generally, in the exam, you are given two fundamental scenarios, treasury bill and policy rate. Basically, you deal with policy rate. But in the exam, if you have been given also, you are an investor of treasury bond, but you have been given this scenario, thinking now you can see treasury bill, government treasury bill rate has gone up. Then, if you are not specifically, the examiner asks you what will happen, you will be earning a profit or the capital gain by investing treasury bill, treasury bond in future. Obviously, you will not. Why? When the interest rate going up scenario, the people who are holding government securities are losing. We learned this in class, remember? So when you are holding the government securities, you don't like interest rate to go up. Why? The price and the interest rate has negative relations. When the interest rate or the yield going up, price comes down. So then you don't like interest rate to go up, people who are holding government securities. So the particularly examiner tests you on the government security itself, not the entire economic fundamental. By giving this kind of information, then you can expect the person holding will losing. Why? Interest rate going up. Then examiner can test you, are you recommending to invest in government treasury bill or treasury bond for long term or short term? This kind of scenario, this kind of prevailing interest rate scenario. So then we can ask you question, do you recommend short term investment in treasury bond long-term investment in treasury bond. So then the question can come. Policy rate unchanged. But given this example, you basically recommend go for short term. Why? There's a tendency the interest rate to go up in here. So we have learned four types of yield curve. Increasing, decreasing, constant and comes down. So basically now presently we are actually experiencing a low regime, but tendencies in the future interest rate will go up based on these scenarios. So very important for you to understand the present scenario, prevailing scenario, rather than we discuss. I think 1 or 2 months ago we have discussed low regime of interest rate and treasury auction result sheets have completely, compared the last option, current option, interest rates were down. Now it has changed. Time to time it can be changed. So the strategies also has to be changed accordingly. The earlier, when the interest rate downward scenarios, when you have interest rate downward scenario, we are not recommending people to invest low term. We are not recommending to. So when the interest rate also going up, started to going up, we are not recommending people to invest low term. Why? There is an opportunity for her to invest short term, then you decide go for long term. And also when you have a low regime of interest rate, we also not recommending to go for long term. Why? The lowest interest rate scenario, why do you want to block your fund for long term? So that's a fundamental situation. So then somebody can say, if the figures give future interest rates also coming down, then only you decide, even at a lower regime of interest rate, you go for long term. Generally, we are not recommending people to invest longer term investment at a lower regime of no point. Now, if you, so for example, now today, 5-year treasury bond is going at 7%. 5 years. Now, if you decided to go for 5 years now at 7%, that is your call. Are you willing to invest at 7% for 5 years? Or otherwise, now the figures giving in future interest rate will further come down. Then you invest 5 years. The figures show you future interest rate also coming down. What are the figures, economic fundamentals we can tell us whether interest rate will go up in the future or come down in the future? Policy rate, inflation, GDP, exchange, all these fundamentals are get together. So then you decide, somehow the interest rate will come down. So then I should, even at a low regime of interest rate, I will block my funds for long term. Why? I'm exposing to reinvestment. That's one thing. So somebody can think, at a lower regime of interest, why should I invest for 5 years 7%? I have invested for 5 years 13%, 14%. So I'm expecting that level to come. So do you think in future interest rate will go up? How do you decide this? One thing is yield curve or the economic fundamentals. So we think that in future inflation to come down, exchange rate to come down, GDP to go up, then you can decide interest rate will somewhat comfortable to you. Now see, when the interest rate in a country comes down, has a low regime of interest rate, foreign exchange income also less. Foreigners are not coming to Sri Lanka and invest. So the foreigners are bringing foreign currency. They don't bring foreign currency to Sri Lanka, invest in government security. So then you are losing. So then generally, when a country's foreign exchange rate also has a direct impact, direct relationship with the interest rate as well. So all these fundamentals are going to be. So you can't take one decision, you can't take a recommendation based on the one decision, one economic fundamentals. But in the exam, if you have been given the policy rate, that is the key. If the policy rate increases, definitely interest rate will go up. So the policy rate comes down, interest rate will further come down. No constant means prevailing situation will be prevailing. So that is very important for you to understand what's happening presently in Sri Lanka. Any question you have? We have been discussing, this is something else. I just wanted to give you some background on what's happening on the interest rate. Now, interest rate. It's important for you to understand why you are working in the investment banking division. Then your recommendation should come whether the investor's money will be invested for long term or short term. How do you decide based on this? Before 2 months, we took a decision. We have not example, right? We have not going and invested for so long term. Now you have completely different situation now. You can decide like that. So basically, depending on the situation, only you decide, right? Now, we have been doing mergers and acquisition. There we have completed our topic mergers and acquisition. Then we need to start this. Sorry, corporate restructuring. Right. So basically, corporate restructuring means what? Corporate restructuring means loss-making companies you turn around to profit-making companies. So when the company is making losses, what will happen? When a company making profit, when a company making losses, what will happen? Basically, the shareholders' wealth minimizes. The amount you put as capital is eroding. The amount you put as capital is no more there. But do you expect by investing in a company to erode whatever the amount you invested? No. You would expect. You need to improve, you need to increase the shareholders' wealth, net worth. Shareholders' capital plus, share capital plus equity. Share capital plus reserves, meaning equity. When a company is performing well, equity amount is going up. Equity amount is going up. Shareholder wealth is going up. So basically, by investing in a company, you expect that. But when the company started to make or incur losses, you don't have it. So then what do? One thing is simple, you have to bring capital. One thing is, you have to bring capital. Say now this is a listed company. There's a listed company making losses. Listed company also can be made losses, right? Listed company making losses. So what do? The first option you have, you tell investors or the existing shareholders to put more money. Now say you are a shareholder of this loss-making company which is listed in the share market. ESC. How do you ask existing shareholders to put more money? What's the method we have learned? That's a question. The latest paper as well, right? Latest paper as well, there were two questions, the text type question and two mark question as well. The method of raising capital. It's a right issue. Right? So you're asking existing shareholders to put money. Under which right you are telling them? Preemptive rights. Preemptive rights. Now, all these things important for you to score in the exam. And you're asking existing shareholders to put money. Right issue is for existing shareholders a discounted price, lower than the market price. You have been given the offer. You are a shareholder. Do you invest? You have been not been paid any dividend so far for long period. Again, the company's management is asking for you to infuse capital, infuse money. Do you do? You don't. You don't do it. The exist to the when a company is making losses, very difficult existing shareholders ask to put money and very difficult to convince them. No, no, in the future, don't worry, once we receive this money, we will have a better future. Very difficult to convince. Very difficult. So then, very difficult to convince. So the existing shareholders not willing to put additional money. Additional money. So very difficult to convince existing. Then what do you do? So another option is for you to sell out. You have to divest. That is another option. So then when you sell the company which is loss making, you don't get whatever the expected price. So when you sell a company, the selling price, what do you call? How do you call it? Selling price? Purchase consideration. You have learned. Right? When you are acquiring also you have to pay money, that is purchase consideration. When you want to sell it, that is purchase consideration. There you take financial and non-financial factors as well. Financial and non-financial as well. So the goodwill is not available. Sometimes this company even incur losses. Sometimes this company might have goodwill. They might have goodwill among the public. It has not been factored in the final estimate. You can have it. It's different matter. Trade scenarios also you can incorporate in when the pricing. So that you can have better pricing than the existing pricing. Meaning is what? So when you value a company, generally screening value is if it is not listed, net asset. Share capital plus reserve, that is equity divided by number of shares, that is per share value. If it is listed, there is no screening mechanism available. The demand and supply price is anyway there in the share market or the CSC. So that is the latest pricing. You do whatever addition to that price only. From that price only you started to do this. But you know, share market pricing is not reflecting actual net worth of the company. That's true. Now what's happening now? It has come down. It has reached to 9,000. Now it has come down to 7,000. For the good companies valuation also has come down due to the reduction of the what you call the reduction of prices of the share market. That is not because of the company's affairs. There is a fundamental country's Economic factors only impacted to bring down the interest, the share market prices of the companies. That is not because of companies are not performing bad, not performing well. That is not the reason. Bring down the share prices. That is something else. But you can't have, somebody can tell, somebody can say, share market does not reflect the correct prices. That is also true. That is also true. So then what do you do? So that's why we generally we do a due diligence and the independent auditors to value the company. Even we say share market, the prices are demand and supply prices are readily available. That price may not reflect the correct valuation of the company. Company is doing very well. Company is doing very well, but the share market price has come down. Now John Case is doing very well. Example, for the market, due to the market come down, yeah, the John Case prices have come down. It is not because of the John Case is performing not well. No, the market fundamental scenario, the systematic risk. We have learned this systematic risk, common to everybody. Now, why this share market is coming down? So, when the share price is coming down the market, how do you hold that market? There are two types of market: bull and bear. Bull and bear. So then, when the share market prices are coming down, what kind of market we hold? We learn this. So it is important. Why the share market prices are coming down? Presently, it has reached to 9,000, and there were a lot of questions on share market this recent paper. Why the share market coming down? So the one thing is the fundamental decisions taken by the SEC. That is one thing. So based on the credit, broker credit, they have taken some decisions. So that is one reason to come down the shares, and also the lack of participation of foreigners. We don't have foreign investment in share market now. At most, only the local retailers are running the market. If they don't have money, there is no survival. So very difficult to boost the share market without having foreign funds. Very difficult. So then, so market is coming down at the moment. Sometimes somebody can say that it will further come down 6,500, but this is the ideal time for you to buy it. That's true. If you value the company, I will be uploading today or before the next week, and the investors ratio, price earning ratio, dividend yield, interest cover, and all. Generally, when an investor invests in a company, they calculate all these fundamental technical ratios. Then you decide it's worthwhile for you to go for this investment. Technically, you should do that. The important ratio is price earning ratio. Price earning ratio is a very important ratio. Now, price earning ratio, the amount you pay to acquire a company, how long will it take for you to recover the investment? Similarly, we learn, remember, in the project appraisal, we learn payback period. Similarly, when you invest in shares, important thing is to know price earning ratio. How long will it take for you to recover? There was a question in this paper. Which one you select? Longer one or the shorter one? Price earning ratio. How long you like your investment to recover quickly or little longer? You like investment to recover quickly. So the price earning ratio, given two scenarios, two price earning ratios, then you select the lower one, lower company, the lower price earning ratio. So all these things, fundamentals, very important for you to invest in shares. Now, similarly, this loss-making company. So then you decided to say loss-making company. Somebody is there to act. Now remember that when the government SOEs, the plantation companies making losses, but the government was able to sell these companies to the private sector. So why do we purchase? Why do we buy a loss-making company? Why do you buy a loss-making company thinking that future is perfectly all right? If the future earning scenario is happening, you think that, then you obviously go and buy very good investment. Even at a loss-making company, you have the capacity to turn around the company. Remember the word, turn around. So the loss-making companies, you turn around to profit-making companies, meaning is what? Capital restructuring, corporate restructuring. So the corporate restructuring is loss-making companies to become a profit-making company, which is turn around the company. So you have then the clean balance sheet. There is no losses. Share capital plus reserve. Accumulated reserve is your profit or loss. When you have accumulated losses, then you have losses. Then your accumulated profit becomes accumulated losses. When you have accumulated losses, the capital also eroding. So then you have a clean balance sheet after you restructure. Then you have started to make profits. And that is one thing. So you are asking existing investors to invest, and you are selling. And also another existing method is while keeping the company, if you want to run the company, you can have more profits. How do you make more profits? How do you make more profits? You want to make more profits, then you should have more sales, and you should bring down the cost of sales. That is one thing. So you can recruit new management, you can recruit new people and increase the sales and bring down the unnecessary cost. Then you started to make profit. Lot of companies are doing that. Lot of loss-making companies are turn around the company by improving the income statement. Meaning is what? Having the more sales, having the lower cost of sales and administration. It's very important to understand. These are the methods for you to restructure companies and also understand reasons for restructuring. And these are the things you can read it. And form of restructuring also important. These are the things we just discussed. Methods of how do you restructure company, methods of restructuring, right? And horizontal mergers and all those things we have discussed with you. Horizontal and vertical. Horizontal means same line of business, right? Right. And this one I have uploaded to pre and post. And also this one I wanted to give you a stock market, the little text type description on CSC and column description, because I thought of giving notes and share market. Now we have separate minister for capital market. So I think examiner has proved that there will be more question in coming exams as well. So that's why I thought of giving a note on this. This is the regulator for capital markets. SEC is the regulator for capital markets. Securities Exchange Commission. That is, he is the regulator for capital markets, right? And CSE also where the trading flow is maintained. An important thing is for you. This is the now when you open a seed account with a share broker, we call it a CDS account. Everything is recorded there. It's scriptless, central depository system. And this one I want listing requirement for you to be listed. If it is a new company, for you to be listed, these are the criteria. It has to be there. Main board, we have learned two boards specially. One thing is main board, the other one is D07 board. We have learned many boards, right? Default boards we have learned, Empower board we have learned, MCB board we have learned. We have learned now. Generally, if you want to list, these are the two boards. D07 and main board. These are the requirements for you to be satisfied for listing in the two boards. So keep in mind. And also remember, once you become a listed company, you have to comply with the continuing listing requirement as well. Now this is before you being listed. I'm a company not listed. I need to satisfy these things. See, now there are listed companies. For example, we say John Key. John Key is a listed company. Now, after you being listed, you have to comply with continuing listing requirement. I'll be giving on a note when you're doing questions. I'll be taking that question with you all. Continuing listing requirement, annual report, annual general meeting, directors appointment, directors withdrawal. Everything has to be informed. So those are the listing requirement, continuous listing requirement for you to be satisfied after you being listed. So important thing. And also this is for your knowledge purpose only. Eurobond. So Eurobond means what? Anything you issue other than your home currency. Now this is the hot topic these days. ISB. But examiner has not tested anything on ISB. Right? International sovereign bonds. International sovereign bonds. So how does it relevant to us? What is the relevant to us? As a country, yes, it's relevant to us as well. When you have ISB, now we have IS international sovereign bond to be settled on 27th of July, 1 billion. So thinking is whether we go for international market or not. So that is one thing. And also remember, once there were a lot of discussions on panda bond and samurai bond and also sukuk bond. Have you heard this sukuk? Now panda bond is what? Issued in Chinese renminbi. Samurai bond issued in Japanese currency, JPY. Sukuk bond is what? Sukuk bond is basically bonds issued under Sharia compliance laws. Anything you issue under Sharia compliance, so meaning there is no interest portion in Sharia compliance products. So that is sukuk bond. To understand, examiner can test you for 2 marks, panda bond, samurai. Earlier, now the previous government, there were discussion on this panda bond, samurai bond. And euro bond is anyway there. Anything you issue other than your home currency. Now, if dollars selling issue that is a euro bond for us. It's a euro bond. For us, it's a euro bond. ISB is a euro bond, not issued in LKR. Right? That is for your knowledge purpose. I have given this notes to you all. Any question you have at the moment? Do you have any question? Now see, now we have concluded. We have, I have only few notes to be uploaded. One thing is loan syndication and the investor ratios and some important small topics which you are for you to read. And securitization will be starting today. Then we are actually completing your syllabus. So basically we have come to a conclusion of the syllabus coverage. So then basically then we can start the questions with you all, and I wanted you to be ready with past paper questions with you all from 2014 onwards, 2014 September onwards. There are questions papers available, so we can start. I have read to you the latest paper last week, and how easy for you to sit for the exam. So all questions examiner has tested confined to the syllabus. They have not tested anything outside the syllabus. If you learn the syllabus well, plus if you do the past papers question, more than enough for you to pass this exam. And also you should have kind of knowledge on what's happening. What's happening. Now the first question examiner tested you, the latest exam, so the settlement date of the shares. It is not available in your tubes, but when we discuss the share market, we have learned it. When we discuss the treasury bill, we know when's the auction, Friday is the settlement. It's not specifically available in your tubes, but when you learn the syllabus content, it's available. It's a 2-mark question, the first question. Now, when we're doing the foreign exchange market, we learn cash, tom, spot. Cash means today, tom means tomorrow, day after tomorrow is spot. Specifically, anything after spot we discuss, that is forward. So the examiner can test you those things. Right? That's the way everything is similar. When you want to settle the dues, then you do it spot. Day after tomorrow. Common. So everything we have discussed in the class only just to refresh what we have done. That is more than enough for you to pass this exam. That is when you're doing the past paper, you will be realized how many questions are repeated. Same question repeat. Any question you have so far? Then we have so basically now basically I thought of starting the question with you all from the financial operation paper, financial market operation. That is very similar to your exam paper. So then, since you don't want to, since you have not familiar with, there are a lot of questions in that paper. So we will discuss that with you all, and also I have given some questions to you all previously as well, just to refresh your knowledge. Remember the issue on those things. If you feel some difficult question, you bring it. We can discuss that as well, right? So we can do that. Now, what do you mean by securitization? Examiners generally test you not frequently, but There are some ancillary things also he tests you relevant to this securitization. Relevant to this securitization. Now securitization means what? You see amount work, but only the name is little different, you feel it, but nothing. Now say understand this very well. It's very easy. This is another instrument. Why do you want to learn? Now when you are working in the investment banking division, why do you want to learn securitization? That is another method of investing. Clients fund. We're learning all these things. Remember the first lecture we discussed. We are learning alternative investment opportunities. But we know only one investment opportunity, that is FD. But since you are investment banking, people investment banking division are working in, you should have many more. I give money to you, give me a return. I don't have expertise. I don't have time. I'm giving money to you to earn on behalf of me. And you give me a return. If you have decided to put it everything, my money in the FD, why should I give it to you? And I have to pay a fee for you as well. I don't expect. So the securitization is, which I don't know. I'm investing. I have never invested in securitization paper. So that's why I come to you. It is up to you to decide whether my money will be invested in securitization paper. That's your call. I don't mind your investment opportunities. I don't mind. I'm not worried about your already investment opportunities. Now, what do you mean by securitization? Now, see, when you go purchase a vehicle, generally you go for leasing. If you have money at once to pay off, then that's fine. But when you don't have money to pay at once, then you go for leasing. So what happens is when you come to an agreement with the leasing company has an agreement with අවුරුදු 5කින් ගෙවන්න. Installment 60ක්. මාසෙට එක ගානේ අවුරුදු 5ට installment 60ක්. So you need to buy a Toyota vehicle, example. And you decided to go and you go to the leasing company and have agreement to pay. So then you will make the payment, monthly payment to the leasing company for 60 months. But the leasing company has already settled their amount to the Toyota. The transaction finishes. The transaction finished. Now the transaction is with who? You and the leasing company. Now 10 million vehicle cost. There is a cash outflow from the leasing company, 10 million to Toyota. And they'll have to settle it. The leasing company has to settle it. But you give money to the leasing company for 60 installments over the 5 years. Today there is a 10 million outflow from the leasing company, but he received money over the 5 years. There is a mismatch. How do you do? There is a mismatch. Then the securitization comes. Then the securitization comes. Now, who is having the CR, certificate of registration of this vehicle, leasing company? So anybody who is having the CR is the owner. Is the owner. What does the leasing companies do? They sell the CR to somebody else. That is securitization. They prepare a product based on the CR, leasing company prepares the product, or they can ask you to prepare a product. Then only your role is important for them. Leasing company asks you to structure a securitization paper. You structure it. අවුරුදු 4කින් ගෙවන්න තියෙනවා මෙච්චරයි. අවුරුදු 3කින් ගෙවලා ඉවර කරන්න ඕන මෙච්චරයි. මෙච්චරක් මිනිස්සු ගෙවන්න ඕනේ. මෙච්චර අවුරුදු 5කට තියෙනවා මෙච්චරයි. Then you prepare a structure paper like that. Securitization paper. Then you invite investors to invest. Then the leasing company has money. If the customer does not pay installment, now when you invest, now say now you are the investor, now leasing company or leasing company prepares they have prepared a structure, they have structured a securitization paper, they have launched it and say I am the investor, I am an individual guy, I need to invest in securitization paper. Generally institutions are investing, right? Mokari institution and securitization papers so I am investing. So all these certificate of registration of cars, this CR comes to this particular investor. Okkuma CR has to be given to this particular investor. If the leasing company default, the customer, the agreement with the lessee and the lessor, the lessee has to pay to the leasing company. If he does not pay, then what happens? There is a replacement of CR. I'm an investor. The new CR will be replaced with the existing CR. That's the mechanism. But only thing you need to understand, there is a mismatch, cash outflow and cash inflow to ease out that there is a new investment. You're asking new investors to come. Then the leasing company gets money. Then the leasing company gets money. Then the leasing company gets money. Then everything, the cash deficiency will go. So that's the intention of having securitization paper. And in the securitization paper, remember, there are parties. There are few parties to be involved. And this was tested, examiner, quite sometimes. This one. Originator special purpose vehicle. What is an SPV? Now, when you prepare a securitization paper, you transfer this. Now, leasing company has to transfer this CR to particular virtual company. We call it SPV, special purpose vehicle. So the new investors will invest in that particular paper, where the new company or a virtual company is formed. That is special purpose vehicle. The entity which buys assets from the originator. Originator means the leasing company. So the leasing company will transfer whatever the CR to this particular company. Transaction right? So then they will transfer. Then they don't have any liability. Leasing company. So this SPV will work out with the investment banking division and they will do the investment. So similar thing. That's and credit rating agencies. Now, for me to invest, now lot of companies preparing this securitization papers. So then you are actually encouraging new investors to. You are preparing new investors to put money based on the rating. Now say, for example, Orient Finance, the leasing company, they prepare a securitization paper. Then he asked him, the Orient Leasing Company is uh, uh, inviting normal investors to invest. So how do you get to know Orient Finance Company's position? Similarly, you go for credit rating. For you to get the third party idea, we have already learned. How do you get the third party idea or the third party's view or the now saying your bank issuing a debenture, so you are asking me to invest. How do you get to know what's happening inside your bank? Somebody independent guy should be there for me to give an information. What is that? Credit rating agency. Similarly, credit rating is very important under the securitization. Very risky investment. Very risky investment. The rates is also quite high. The earlier it was 14%, 15%, and there was a withholding tax also involved. It is a huge, big rates, the significant rates. Why? It's huge risk carries. If the leasing company does not honor whatever the lessee does not honor the leasing payment, the leasing payments are very difficult to recover. Hmm? If something goes with the lessee, they don't pay. Very difficult, so very risky. So the very difficult to convince the investment or the investors to invest. But you can have higher return, but there is a high risk by investing securitization paper. In Sri Lanka, we have not much sophisticated market, but if a country like India, we have very sophisticated market for securitization paper. Now, vehicle, auto loan is one. Now see, the products, what are the products we can do? These are the products we can go for under securitization. Auto loans means car loans, student loans, mortgages, credit card receivable, anything. You can securitize. You can prepare papers for securitization, right? It's very important. But only thing, important part here is to understand the concept, and this one is also tested several times. Asset-backed securities and mortgage-backed securities. Only the literal meaning. Only the literal meaning. So nothing else, right? Nothing else. And understand and keep in mind this as well. So very summarized note I have given to you. Very summarized. Everything contained there. Everything is important. And why the role of SPV, why we go for securitization, who are the parties involving, so all those things very important. And what are the products to be securitized? Everything is important. You need to understand. So securitization, there are few questions, and this question now questions, the answers are there. All these questions, if you read this PowerPoint presentation, it gives all the answers for the question the examiner has tested so far. Right? It's important for you to learn and understand. This is the process. Now, examiner has not tested the process, but the due diligence process tested, and also you can test the process as well. At least 5 steps. You can combine. This is the steps, right? Uh, this is the process, and keep in mind at least the examiner can test you sometimes. All right. Any question you have? That is securitization, right? Any question you have? And 2017 March. Question number 2. In the aftermath, I'm just reading. Right? In the aftermath of the subprime mortgage crisis and ensuring credit crunch, the world of finance is returning to the fundamentals of valuation and critical due diligence for mergers and acquisitions. Now you know that's the heart is. We had a subprime mortgage crisis, right, in US. Credit වලට ඉතින් අරගෙන ඉවරලා they couldn't pay and collapse. Question number 1. Briefly explain the method, terminology, due diligence, and explain the importance of the due diligence in M&A. Explain the valuation method used in the M&A. Briefly discuss why the companies do M&A. Explain the differences between horizontal integration, vertical integration, and conglomeration. 4 questions, sub-questions, 20 mark question. 20 mark question. So it's very important just to write. And if you learn this properly, you can easily answer these questions as well. So those are the question examiner test you. Right? Those are the question examiner test you. So those are the questions. I just want to give you some background to what the examiner test you. And this is question number 3, 2019 March. Now see, define mergers and acquisitions are increasingly becoming strategic choice for organization growth and achievement of business goals. Define and state the motive of horizontal merger and conglomerate merger. Now I have told you there are 2 types, horizontal and vertical. But examiner test you sometimes 3 times, sometimes 4 times. So if it is 3 types, conglomerate is the third one. So I will be uploading the institute for you all. It's available, these things, everything, right? There are 4 things available. So depending on the question, you can answer. And state 5 reasons for multinational companies to use cross-border mergers and acquisitions. Why you acquire offshore companies? Same thing. Even you acquire a local company, even you acquire a foreign company, same thing, but only thing, foreign investment coming, foreign experts coming, foreign technology coming. That's all. Economy of scale, the market share, everything will remain as it is. So you can only thing you can go to the international market. You have international presence by acquiring or by merging foreign company. State 3 basic analysis of techniques to value the target company. Valuation techniques. Describe 3 common forms of divestitures used by investment advisors in corporate restructuring. First time examiner tested corporate restructuring question connection to the mergers and acquisition. So easy questions the examiner test you. I'm just giving you an example. So the things we have learned in this class already tested by the examiner. So nothing else, no new things. Only thing just combined to what we are learning, what we are teaching, what we are discussing in the class. That's more than enough for you to pass the exam. Mergers and acquisition is basically the accounting subject. But examiner investment banking division, very important role. Now I have given you roles of investment banking. Remember, then mergers and acquisition is a very important topic there. It's one of the roles of investment banking, investment banker. So then we can't avoid it. It's very important. And recently, I just wanted to tell you another thing. Those days, though sometimes 3-4 years ago, IPO was very, very popular. IPO is what? Initial public offering. Now, recently we have seen there is IPO going on. So I will be discussing this. I will give this notes to you all. IPO. So the price and how the prospector will be there. Now, when you're doing an IPO, prospector is compulsory. Prospector is what? Containing all information, like D07, all information in the book. Why? You are inviting third party to invest. So then you should give all the information to the third party. That is very important. Very important. So all this information available on the company, what they are going to do with this money, what is their planning, directors, everything is available in the prospectus. So when they print the prospectus, I will show it to you. I will upload the prospectus, then we can discuss the contents. I have the old one, but not necessarily go for old ones. The print one, I will give it to you. I will upload the latest prospectus for you to go through. Only thing what you want to go through is the contents. What are the contents available in the prospectus? That's all. That's all. That's more than enough to understand. And also, then how do you decide the pricing? Now, this windfall is the company they are going for a IPO. 16 rupees is the pricing, right? So this is another method of being listed. Now, see, everything we learn is very live. They need money, and they want to be listed. Now, if the company doesn't need money, then they want to be listed. Is there a method? Yes, of course. We have learned that. I don't want money. My company does not need money, but I want to be listed. Is there a method? Yes, there is a method. So all these things important for you to understand and learn. So we will be discussing some questions from next week onwards. So just be ready with the past papers. Be ready with the past papers. I will take some text type question initially, so then you can have refresh your knowledge as well. Right. So any question before we wind up the class? Do you have any questions? So I am requesting you to ask questions. So then only you can learn. So then you can watch the video later. That's true, but you have the opportunity to watch the video later. But since we are not physically meeting, I'm requesting you to ask some questions to clarify if you have anything. So that is important for you to learn, and that is important method of learning as well. So asking questions, right? So I'm requesting you to ask questions as well. At least from next week onwards. Then when you read the question, rather than just listening to the question, is not going to work. Then you should ask question. This is the method. This is not the method. You just recommending us. For you to do this, you should have kind of knowledge what we have done so far. Please just go through this. We will be starting relevant questions. So there is a method of repeating the questions as well. Not all these questions are repeating. So we will be taking that into consideration, and we will complete this question and answer session. Right? If you have any questions, you can raise. Otherwise, we can wind up the class. Right. Then we will wind up the class. We will be starting questions and answers next week onwards. Right? Thank you very much.